Hey guys, it's Nick, and in this video, I want to talk about what really happened at Zillow. Did the AI algorithm just run amok, or was it tweaked on purpose to buy more houses and overpay in the process? Now, the Wall Street Journal has a story explaining this much better than the story that was told by the CEO of Zillow. The program, Zillow Offers, was originally supposed to make money primarily from transaction fees and services such as title insurance, not from flipping homes for big profits. But Zillow's first quarter delivered home sale profits that were actually more than twice as high as they anticipated. But by the summer, it had the opposite problem, and the company later acknowledged it was paying too much money for homes and buying too many of them just when the price increases were starting to slow. Zillow's algorithm was designed to predict what a home would be worth in a few months and offer a cash sum to the seller that would allow the company to make minor upgrades and repairs before flipping it for a tidy sum. Home sellers benefited from an instant cash offer, which cut out real estate agents along with listings and showings during the COVID-19 pandemic. Zillow's original plan was to make no more than just like 2% profit so homeowners wouldn't feel cheated. Now, from the sound of it, it sounds like a pretty good plan, especially during COVID, where maybe people don't want real estate agents and other strangers coming through their house. The plan to aim for a 2% profit on the purchase price sounds pretty risky because with such thin margins, you can lose money pretty easily if you are even a little bit wrong about the market, or if the market turns, or if you underestimated the repairs the home would need before you can put it back on the market. The entire model relied on the algo's ability to predict future home prices based on its already successful estimate, which the company said in recent years was accurate within a median error rate of 2 percentage points. So, what went wrong? According to the Wall Street Journal, Zillow went beyond the limits of their technology in an industry where buyers are ultimately following personal tastes, emotional attachments, and other intangible factors. So there's a lot of emotion and personal taste in buying a house, and almost no two houses are alike. So an AI can't tell if the layout is attractive to buyers, or there's curb appeal, or any other kind of intangibles that a local real estate agent may understand better. So, compounding their missteps, Zillow, while understaffed, scrambled to play catch-up with competitors and disregarded internal concerns that the company was overpaying for homes, according to current and former employees. The company also suffered from supply chain issues and labor shortages that hindered its ability to quickly renovate and flip homes in what is described as the breaking point for a business that executives once predicted would generate $20 billion in annual revenue. So here the truth comes out. It wasn't the AI that went haywire. They were overpaying for houses, and they were well aware of it. And they say in order to try and account for aesthetics, Zillow incorporated photographic analysis into its home pricing metrics in 2019, which included factors such as natural light, the quality of interior finishes, and curb appeal. It also hired over 100 pricing analysts to double-check the algo's figures by looking at recent comps in the area, which was aimed at reducing the risk of overpaying, but made it harder to quickly flip a growing portfolio of homes in major metropolitan areas. So they had 100 pricing analysts double-checking the algorithm's figures, and they continued to overpay. This doesn't make a lot of sense. So they can either offer the correct price for homes, or they can quickly flip them, but they couldn't do both, even with 100 pricing analysts. So then an unexpected surge in home prices and real estate activity during the pandemic caused their algo to go haywire as buyer preferences began to change in unusual ways. And they say that shift in buyer preferences is extremely hard for a machine learning model to incorporate, said BiggerPockets VP of Data Analytics. This seems to have a lot to do with people moving out of cities and into suburbs during the pandemic and because they can work from home. But how do you account for that in the algorithm? I don't know. So in the spring, Zillow executives and managers had a meeting, and while the company was making more money than anticipated on the flips, they were on track to miss their annual target for the number of homes purchased, falling behind top competitor Opendoor. So this seems to be the real reason for them overpaying for these houses. They wanted to meet their annual number for homes purchased so they can say they bought more homes than Opendoor. This is code red, said Joshua Swift, Senior Vice President of Zillow Offers, during the virtual meeting. And following the meeting, Zillow hatched, I kid you not, Project Ketchup, designed to speed up the volume of home purchases by purchasing more homes on an accelerated basis and making offers which were well above what the company's own algorithm predicted as a fair market value, according to people familiar with what happened. So there it is. In order to get more home sellers to accept their offers, they offered a lot higher than the algorithm said they should offer. Our observed error rate has been far more volatile than we ever expected possible, said CEO Rich Barton, and makes us look far more like a leveraged housing trader than the market maker we set out to be. So in Phoenix, home to one of the company's largest portfolios, the median price Zillow paid for homes rose from $351,000 in May to $475,000 in September, at a time when competitors were easing off the throttle on their own purchases, according to Mike Delpreet, a real estate tech strategist at the University of Colorado Boulder. Now, fast forward 2 months later, and Barton now says the company expects to sell its homes at a 5 to 7% loss, down from an average profit of nearly 6% in the second quarter. The company halted its future home purchases for the remainder of the year in mid-October and notably shut down Zillow Offers for good earlier this month. We determined that further scaling up Zillow Offers is too risky, too volatile to our earnings and operations, and too low of a return on equity opportunity, and too narrow in its ability to serve our customers, he said. So the truth comes out. They had the algorithm working pretty well, but they chose not to follow it and pay up so they could buy more houses to meet their yearly objectives, which I'm sure their bonuses were tied to also. If you think about it, Zillow Offers might have still been in operation today if they didn't try to outdo Opendoor. If they just followed the algorithm, they would have a lot less inventory at much lower prices and would be able to keep this going at least for a while. So this is the danger of companies setting ambitious goals and then not caring how financially damaging it might be to reach them because you are using other people's money. In this case, the $1 billion that they got from selling bonds to do this. So in about 1 year, they will have torched about $560 million on that from the total losses they expect to take from this. So if the CEO of Zillow was using his own money to buy these houses, I guarantee you he would not be paying up for them just to meet some arbitrary goal. So guys, there's a lot of blame to go around for this whole Zillow fiasco, but the only person that is completely innocent here is actually the AI algorithm. If you like this video, hit the thumbs up, and I'll see you in the next one. Thanks for watching, guys.